Hey folks, welcome to another episode of Business Redefined, your weekly most comprehensive look at the world of business, finance, and economics. We are right at the heart of the Nairobi Securities Exchange. There's a new sheriff in town, Mr. Frank Mwiti. Welcome on set.
Thank you, Julius. Happy to be here.
Finally, our schedules have aligned.
Finally.
Glad to have this conversation.
It's taken a while, but here we are now.
Here we are, bro. Frank, congratulations on the job.
Thank you.
It's been about 4 months by my count ever since you assumed the office,
Yes.
effective May.
Yes.
And you seem to have taken over with a high tide surfing. The market looks up, the macro fundamentals have not been bad, barring what we've seen with finance bill, etc.
Yes.
How has it been so far?
Exciting. Insightful, given the last 4 months, but also clearly there's opportunity for growth, but it does require a very strategic approach, and I'm looking forward to talking a bit more about what we are thinking. But so far, I'm happy.
Okay.
And I think the market is as well.
Fantastic.
Yes.
Frank, I'm one of those who are a bit surprised
Yes.
by your appointment. By extraction, you come from the private market side.
Yes.
Here you are assigned to the public markets. What differences do you see that you'd say are stuck? And what value do you intend to bring from the private market side
Yes.
into the public markets?
Got you. So you're right. I come from the private markets, but the capital markets in general is not new to me. Spent quite a lot of time, a lot of years servicing clients from an investment banking background as well as corporate finance. On this side of the table, there are some elements that are actually slightly different. I'll give a good example. You can tell that the interface with regulation, with government, with let me call them public sector stakeholders is a lot higher compared to private markets. The interface with larger foreign investor community is also quite pronounced on the public market. And of course, the interface with retail investors who are surprisingly very demanding is actually a lot more pronounced, especially in this era of social media and the digital forums. So that has its ups and downs. Of course, also this role also has a very public profile, which means I need to be continuously conscious of being in representing an organization like this that is very critical to our economy, but that also requires a lot of public scrutiny and the other spotlight moments. On the other hand, there are actually areas where I can see clearly these lessons from the private markets that would apply, that would probably move the needle quite a bit on this side. For example, I think our capital market is very fragmented. We have very, very robust stakeholders who are very good in what they do, but then we need the value chain the ecosystem to be a bit more joined up, so that we have our, the brokerage community, the investment banking community, custodians, or all these guys coming together in a bit more robust way, so that we are able now to innovate together and push the market in the same direction. I have to also say that I was slightly surprised by just how much foreign investors, just how big an influence foreign investors have in our market. It is my intention to work very hard to balance that out with by growing our domestic footprint, because I think the market needs to function for domestic investors and foreign investors in equal measure. And I also think that domestic investors probably are more accommodating and patient when we are trying to make significant changes to how things work. And then lastly, of course, is the pace of change. In the private markets, I would say we approach change, head on, and we move fairly quickly.
Yes.
And fail fairly quickly as well, and move on.
Yeah.
I think there are lessons there that we can, borrow from to help navigate some of the challenges that we have on this side, including the fact that by and large an exchange like ours is a technology business. And the technology space, as you know, is moving very, very fast. And also the realization that the competitors are not just here. You are actually competing with the rest of the world.
Yes.
So if I borrow some of the lessons and experience from the private markets, is that you absolutely have to be, switched on and go hammer and tongs on just about any opportunity you see that you think is relevant, but do so, in a very strategic and fast-paced way. So I intend to bring some of those lessons to this side of the market.
Picking from what you've said, Frank, how do you increase the traction of domestic investors vis-a-vis foreign players in a market, and this is my assessment, in a market that is essentially dividend yield driven? From a capital gains perspective,
Yes.
many of us have been struggling with whether the NSE and Kenya's capital markets by and large
Yes.
are a value trap.
Yes.
Because you pour in your capital hoping for a capital gain,
Yes.
it takes 10 years plus.
Yes.
The big investors from foreign markets know BAT
Yes.
has a strong dividend yield.
Yes.
EABL has a strong dividend. They know how to do their play. And
Correct.
that is why
Yes.
they come in and sway the heavy axe
Yes.
in this market.
Correct.
How do you persuade the domestic market when you're in that kind of a situation?
Yeah. You raise very good point. I think it's actually solving for that is literally what I'm waking up every day to figure out, Julian. This is the first bit of it, which is investor education. Obviously, we need to be able to have the majority of our investor community, potential or existing, to be clear on why invest and how to invest. If you're investing for capital gains, the value proposition on some of the counters is very different. If you're investing for different yield, for dividends, that's a very different proposition. So I think there is an element of investor education there. There is a second thing, which is we need to be able to enable investors to come to market without a lot of friction, let me say, and be able to actually exit the market similarly.
Without
friction. Okay? And there are several interventions that are required in that whole value chain, both at the investor side, the brokerage element, our exchange side, the CMA element, this nature of the products that we bring, the tech that we're using, and those sort of things. So we accept that there is interventions that are required across by various stakeholders, including ourselves as the exchange. And those interventions need to be customized to different segments of the investor community. My view is that, number one, our domestic investor community needs to be a lot more aware of what the opportunities are in our market. Similarly, our issuers, the guys who have the entities that have issued on our market, need to actually engage with the investor community in a more consistent, regular, data-rich way. Okay, we have issuers that don't have very, shall I say, robust investor relation teams, if at all. Okay, that don't put up a lot of information for investors to engage with. That I think do not remember that they are listed. So we need to actually be alive to that. Okay. So, and then lastly, especially with some of the new regulations that have come into play, we think there's opportunity there to actually relook at the structure of our exchange and figure out what we need to change to enable more investors to come to the market: retail, institutional, domestic, foreign. Tech will be a big component to how we solve this issue. I know a lot of times costs, the cost of trading. Yes. But we can't. We need to figure out what the root causes are for example, having certain levels of cost of trading, and then address the root causes rather than just being very reactionary. At the end of the day, Julians, we have to have quality issuers. It makes no sense to do a lot of these adjustments if the quality of the issuers are wanting. Number two, we need to bring more innovative products into our market. We are thinking along the lines of, for example, indices, exchange traded products. We want to bring more to and deepen our derivatives offerings. We want to bring more cross listings, etc. So the point is that we need to have quality issues, we need to have a variety of products, and we need to educate the investor community, and then, of course, address the operational issues. At the end of the day, we have a good market, we just need to improve it.
I see. Frank, there are many who hold the view that this exchange has a price discovery problem.
True.
When you look at the counters and you look at their fundamentals vis-a-vis where the market is valuing them at, you see a very stark divergence.
Yes.
And that explains why increasingly you are seeing share buybacks.
Yes.
Because the people who have come to market
Yes.
are even asking themselves,
Yeah.
is there any strong proposition in being listed anyway?
Yes.
One, do we have a price discovery problem? Two, how do you solve that?
Okay. So the first thing is, of the 60 or so issuers on our equities board, and I've spent the last 4 months meeting quite a number of them. By and large, people are happy to be listed. Okay, so the issue about should I remain listed does not keep me awake at night
At all.
At all. Okay. However, we do have areas of improvement as far as engaging the investor community with regard to what is listed. We have, for example, a simple example to give you is we have corporate actions that are not published. We have companies announcing dividends and people are not aware. We have entities revamping their strategies and not communicating to the market. So there's a gap between what companies are doing, the fantastic work issuers are doing, and what the market should be aware of.
Yeah.
And these are issues that can be solved. On price discovery, now look, in other markets, one of the simple way to achieve price discovery is to allow short selling. I laugh because what that might
Yes.
there are fights to pick up and there are fights to navigate away from. I think for price discovery, what we need to do is to sit and unpack various counters. I'll give you a good example. We have counters where the shares are very closely held.
Yeah.
There's huge demand for those sort of
But there's
shares,
no supply.
but there's no supply. And so what you'd expect as movement to enable you to identify where the price really should be really is dampened, because closely held shares, people are holding them, waiting for the dividends, and that's that.
Yes.
So you have other categories where the liquidity generally, traditionally the liquidity in those counters has been so low as to say, look, there's not enough data points for the price to move left, right, or whichever way. I do think, though, that there are counters that are heavily discounted, and that one really should expect that the prices should be at a higher level. I won't name the names, but you can go buy them and sit tight. But I agree that there's a real issue there. We are in the process of building our new strategy for 2025-2029. Part of one of the work streams in that is actually to figure out how exactly we unlock this issue, whether it's introducing different type of products, whether it's asking for different types of disclosures, or whether it's other interventions, both at the issuer level, at the market level, or any other stakeholder engagement. We will do that in collaboration with the capital markets ecosystem. We've been trying to gather information to enable us actually make the right recommendations. But at the end of the day, we want a proper functioning market where price discovery is a no-brainer, but one that also doesn't bring disruptions to the integrity of the market. I think as we start on this journey of improving our market, this issue about price discovery in by and large will get addressed. The last thing I guess to say is there is a lot of work that still needs to be done on the issuer side, particularly on the quality of disclosures and especially forward-looking data points, so that then people are able to trade off that. Yeah. One of the reasons our data business is growing is that investors are keen to use this information to really make investment decisions. We are seeing even retail investors actually now engaging with our data offerings. And we think that will then also enable them to see, you know what, these places, these counters are underpriced. Yes. And therefore they can then make the right choice. The last thing is we also want to enable investors who do not necessarily have big tickets to be able to come to our market. If you have 100 shillings, you should be able to still come to the market. So we are looking at enabling fractional trading, among other aggregation type trading opportunities, yeah, which means that even more liquidity can come to the market, and in that way we can then have more investors looking at all these counters and putting in bids that are commensurate to what these listed entities should really be valued at.
Frank, we have spoken about fractional trading in this market for a very long time. Mm-hmm. So the quick follow-up there is one, what actionable steps have you taken towards this, and what timelines are you looking at? Okay. And secondly, listening to the first and last leg of your response there, yes, it sounds like share split for some counters is really in your pipeline.
Let me start with the last one, then we talk about fractional trading. The decision to, for example, embrace share splits, truly speaking, sits with the issuer and their shareholders. Yeah. Now we can encourage them, and we intend to, but I think that decision is not a decision on the exchange side. I think what we are seeing is a lot of the issuers now taking time, because of also some of the shareholder agitation, taking time to actually understand how they have actually come to market and how they intend to remain in the market. So you've already talked about share buybacks, yeah, splits. I think those will in all likelihood we might see some of those coming through. We expect to see more activity around corporate actions, actually, generally as a theme. I do not necessarily want to make commitments around, for example, share splits, because I think, as I said, that sits with the issuer. But it tells you that the market, because look, I always come from the position that the market is not wrong. Okay, I think if I always assume the market is wrong, then we have a problem. Yeah. I want to start with the market is not wrong, and then it becomes how do we react to it? Yes. Okay, the astute business leaders of listed companies will solve these issues, because it's a real issue for the shareholders. And the shareholders, by the way, if you attended a lot of these AGMs, shareholders are being very, activists. Yes. So I do not see that pressure easing out. I actually think that the business leaders that get off the block quick enough will actually see their counters improve in that sense, and we'll all be happy for it. Now, and by the way, the nature of the market we are in, where there's a lot of social media information coming through social media, independent analysis, and well-trusted analysts like yourself or information sources such as yourselves are actually helping this discourse very, very much. We evaluate that quite a bit. In fact, if you see the NSE handle, for example, on Twitter, X as it's now called, we actually follow some of this and repost it or republish it in our market, because the quality of some of this research is actually absolutely fantastic. Yeah. And the more the market is engaged with this, the higher the chance that the market will correct itself to and settle at the right levels. The fractional trading, while I can't mention the entity that is already several steps down the road, We are actually looking to have fractional trading live and happening this year. Okay, you can quote me on that.
Yes.
Because we've already given we've had conversations at the NSC. They have had engagements with CMA. They have started the piloting aspect of it. So really, the conversation really is about when do we start. Okay. I think fractional trading will actually, in my view, I think will be a game changer. There is a lot of liquidity sitting in our market that can't come to a lot of counters because of the nature of the way our market is currently structured.
Yes.
Whether you talk about lots, the minimum lots, you're talking about the size of the ticket that you need to
Yes.
actually come to the market, the ability to come to the market and exit the market without a lot of delays. All those things, give me every reason to say we will see the market change significantly once we embrace and enable fractional trading to take place in a well-managed manner. And that has happened very well. It has worked very well in SA. It's worked very well in India and other markets. We think it will get the same success here. And our broker community is actually embracing this theme. So we are working lock in step with them.
Frank, allow me to play the skeptic here.
Yes.
We had a similar conversation when day trading was rolled out. And the argument was, we can see a lot of appetite from Kenyans in the betting and gaming side. We want a piece of the pie. It's been a while. I'm not sure we've moved the needle much. We had a similar conversation when this market came up with securities lending and borrowing.
Yes.
And the argument was, there are investors who hold for the long haul.
Yes.
Why can't we have a securities lending and borrowing framework where I could lend you,
Yes.
you engage in the market,
Yes.
we are both protected,
Yes.
and we catalyze activity?
Yes.
It's been a while.
Yes.
I'm not sure we've moved the needle much.
Yes.
Derivatives.
Yes.
We wanted to cushion ourselves against downsides.
Yes.
Here we are. Do you feel this market has a problem with product uptake, even as you think about fractional trading?
Okay. The short answer would be yes. Okay. The long answer is this. Day trading. We've done just a review just this passing week that's just ended. The way we had planned to, the team that was there at that time anyway, had planned to launch it versus how it was implemented. There are gaps. Okay, so we are looking at it to make it really work and work properly, including following up in the markets where the market is aware. Okay. SLB, same. In fact, for SLB, it's almost starting from scratch. So I think there is good ideas, but it's about execution. We really do have to follow through with the execution and make it work. We don't need to reinvent the wheel. SLB, day trading, fractional trading, these are tried and tested ways of developing markets. We're not actually doing rocket science here, So the question, Julius, must be, why are we not implementing these things properly? Where are the gaps? So that's why we've gone back to say, okay, wait, what did we implement? What did we say? Oh, no, we didn't. We implemented some other things. SLB, no, we haven't joined up. There are some problems at the CDSC level. There are problems at the stockbroker level. And by the way, NSC, you don't have these things. Then all of a sudden, in fact, we are surprised. We should not be surprised. It didn't work. Okay. For fractional trading, we are taking a different approach. Where we are saying, no, guys. We have to absolutely pilot it properly. And by the way, we need to carry the investor community with us. So the launch of this should be, we are launching it from a technology perspective. We are working with our regulators and the other stock market, capital markets ecosystem, and more importantly, the investor community. So to answer you, yes, we have a product launch problem, but we also need to say we have areas of improvement. Okay. The reason I'm very confident about some of these things is personally, I have spent a lot of my professional life focusing on strategy and execution. Execution. That's actually where the boys and the men get separated. Okay. I do think that because the market has not been working so far, and we are looking to solve for that. The market actually is ready for solutions, but we have to really roll up the sleeves, do the heavy lifting to make it work. I have no intention of spending my time doing bearing and then forget that and look for another thing to do bearing. What I want to focus on is, we said we are going to do day trading. We make day trading work. The bearing you should be, we will not only make day trading work, we have hit certain thresholds. Then we can ring the bell for that. The last thing to say is we also should be careful about copy and paste for our mother markets. I actually think that SLB has some elements of that, where we thought to take it from this jurisdiction, paste it
One
here.
size fits all.
Yes. Clearly, we need to manage that. The beauty is for the 4 months or so I have been here, the engagement with the capital markets ecosystem has been very, very positive. We've been having the capital markets roundtables. We've been engaging the CASIB fraternity. We've been engaging the custodians, the fund managers, the CMA. And what is clear is we are all agreed that we need to look for innovative solutions to deepen our market. So yes, you're right. We do have gaps, but we are Kenya, and Kenya is known for innovative solutions. I have every intention to make the NSE a bedrock for innovation and to, more importantly, focus on outcomes. Outcomes, Julian, outcomes, not show, outcomes.
Okay. Yeah. Frank, you know, I hold a different view.
Yes.
I think that the synthesis and structuring of products by the capital market ecosystem in Kenya doesn't fully appreciate the market it operates in. I'll give you an example.
Okay.
I sat right here with your predecessor.
Okay.
When the unquoted securities platform was coming live.
Yes, yes.
And my point was, there are many Kenyans who every day are asking me on social media, can we have a platform where we trade our SACCO shares?
Yes.
And my proposition was, if USP addressed only that, forget about bonds being listed on the USP by players who are not necessarily listed.
Yes.
It would have solved the problem entirely.
Got you.
And that's a daily headache for Kenyans.
Yes.
The SACCO movement is so huge. Yes. Is that a view you share?
It's a view I share. And interestingly, we had our latest capital markets roundtable was yesterday in the morning. And guess one of the topics we discussed was how to support the SACCO ecosystem. And there is a conversation we are having in collaboration with CASIB on how to support the SACCO ecosystem. Two things. The first thing is that we do need to offer a differentiated, tailored, customized solution for the SACCOs. They truly are a different type of organization.
Entirely.
Okay? So that one, which is why earlier I was saying copy and paste won't work. We need to sit and say, what really are the peculiar features that we should speak to as far as SACCOs are concerned, and how do we tweak the USP to cater for that? So I agree with you. I think absolutely, if we just focus on, for example, solving for the SACCO market requirements, it's a huge opportunity. But the key must be we do not copy and paste, and we do not assume what we have will work automatically. We need to actually be responsive to the SACCO's requirements. And that should also be the case for many other different market segments that have their own peculiar, or let's say that have their own unique requirements. Case in point is, for example, startups or family-owned businesses. These are different requirements. So once we say it's only a box, and if you're not going to sit within this box, we can't work for you. Obviously, then we're irrelevant as a market. The beauty is, because we've not gotten vanilla listings coming to our market for a very long time.
Yes. Definitely
longer than I've been here. It tells you our vanilla listing proposition is not working.
Yes.
So we would be remiss to not now pivot and say, okay, wait. Instead of trying to sell what we have, let's actually address what people want.
Yes.
And the SACCO is a good example. I do think that the single biggest issue we have in the ecosystem is follow through. Follow through. You know, if you sit in a lot of the meetings, even our own NEC meetings, we know what we need to do. We do, Julian, but implementing it
It's a different game.
that's a different game, and I think that's where the differentiation will come. I am more interested in outcomes than
Not shows.
show. Although I'm on a show right now, so that's different. Yes.
So, Frank, on that point of vanilla listings, given your background, and by the way, we share that background of private markets.
Indeed.
Do you feel the traction by private markets has really stolen the thunder from public markets? In this sense, there are entities which I have sat with. The only way they raise capital is in the private markets via private equity injection,
Yes.
and then one PE exits into another PE.
Correct.
And you always wonder, why can't you exit via the market?
Yes.
And they will give you a number of reasons. One, we are not sure if we go to market, we'll discover the right price that we want.
Yes.
Two, we're not even sure we'll get the liquidity we want in the market.
Yes.
Do you feel they've stolen the thunder? And two, how do you remedy that?
Okay. So three things. The first one, you can't have a proper functioning capital markets if both the private side and the public side are not healthy and robust. Okay. By their nature, they are symbiotic. They need to go step in step. I agree with you that the majority, for example, of deals, whether exits or buyouts or M&As and all these things, have primarily happened in the public market side of things, and the valuation, some of the valuations have been very, very healthy indeed.
Pretty good.
Pretty good. You can argue that one of the reasons why most PEs in our market are struggling to exit and have been struggling to exit for quite a while is some of them may be overpaid. Therefore, they are asking for valuations that don't make sense. And I've advised a lot of transactions, so I think there is some truth to that. There's the other bit of it, which I think for me is more telling, which is since I came, I've sat with just about every large PE firms in our market, including DFIs. I can tell you without any shame that about 90% of them, I've never had NSC talk to them. Okay? For me, that's a big gap. It means that where we should be farming, we are not farming, you know? So people are not going to, if we sit here and hope that the peas will come to us,
they will never.
That's a problem. No. And I remember when I was in the private side, I thought that maybe, what about an IPO? Okay, so
it was never in your menu of options.
No, it wasn't. And now that I'm here, I'm like, oh wait, actually it's because the NSC itself never got off from our floor and went into the market. So my time and my colleagues' time is being spent talking to the market. Okay? To first of all, to understand, first of all, to articulate our value proposition, and to also take feedback and introspect on what do we need to change to actually have a more compelling value proposition. Valuations, Julians, initially it seems to be the issue, but the more you talk to these PEs, you realize actually, wait a minute, even the valuations that they are getting in their strategic exits and their trade sales are nowhere near the ones that they are asking they should get at the NSC. Okay, so there is that bit. There's the second bit of it, which is understanding the listing requirements, the listing journey, not just for the PE that wants to exit, but for the shareholders that are left in the business. Okay, quite a lot of the PEs have actually taken stakes in family businesses,
absolutely,
which have their own challenges. Okay, so they might have been PE ready, but they are not listing ready. They are not IPO ready. They're not ready for this other conversation. But there is movement that is required from our side to make our market fit for their purposes. I'm confident saying that one of the areas we will see listings, probably not this year, but going forward, would be from the PE DFI community. Okay, and the beauty of our latest discussions is that they are getting better understanding now of our value proposition, and the new polled the public offer listing
Yes.
guidelines, regulations, enable us to actually have more flexibility on how we address the PE community. Lastly, if you look at a lot of the Ps and you look at the LPs behind them, a lot of them are actually DFIs.
Yeah.
So actually what you have are businesses that have taken capital outside of Africa, okay, to invest here.
Yes.
So it goes without saying that it is possible that that capital is not recycled here, but the exits are out. So
Yes.
there's also that dynamic. That's actually is important to also be alive to. Personally, I think we will see opportunities from the PE side, but we really need to be the ones that go to have conversations with them. Our market also needs to offer the right values. Let's also admit that. I'll give you an example. Pension funds have leeway from RBA
Yes.
to plow money into PE.
Yes.
But they haven't.
But they haven't.
They haven't. So the conversations, therefore, it's not about NSC then. Because at the end of the day, the people who have the money are also, by their own, without coming through the NSC, not allocated to PEs.
Yes.
So what does that tell you? You let me interview you now.
Any time I've spoken to trustees about it,
Uh-huh.
what they will tell you is by nature,
Yeah.
our risk appetite is meant to be conservative.
Probably so, but also
But they're far from the ceiling in a way. Prescribed.
quite far.
Yes.
And it's not because of RBA, because RBA in table, is it called table 10 or I forgot table G? I've forgotten. That table actually does allow for PEs to allocate funding.
For pension funds, yes.
Yes,
Absolutely.
yes. And I also think that, although of course, the value proposition NSC brings is the ability to provide liquidity to that. So yes, you can get exposure to PE through the NSC, which means if you do want to exit, you have liquidity at the exchange level. But I'm just trying to say, even the opportunity for pension funds to do direct investments into PEs, that allocation is very low.
Yeah.
So that means we have a disconnect. It's not an NSC issue. It's not, Julius.
If you look at the latest industry statistics for the pension sector, 51% of their assets under management, and right now just shy of 2 trillion, Bob, is in government paper. But story for another day. Let me follow up on something you've mentioned.
Yes.
A lot of these entities might be PE ready, but they are not listing ready.
True.
And Frank, isn't that where the problem is? Because I'll tell you, I remember in transaction advisory, companies would simply come to us with a story. And we help them build their books ground up. Because I was on the sell side, and you help them now be investor facing.
Yes. True.
They don't have as much hand holding when they come to the public markets. And isn't that where the problem is, Frank?
So I will say yes, there's a gap there. At the NSC, we have, I'm sure you are aware of the NSC Iuka Program. One of the problems that NSC Iuka Program was meant to address is how do we take entities and enable them to get in to become listing ready, investor ready, come listing ready. I think there have been some successes, but we are in the process of repurposing the Iuka program to be a bit more, not to be a bit more, to be fully fit for purpose to actually address this issue. For Iuka to work, we also need our ecosystem to also support that. We need transaction advisors that enable, that contribute to that. We need tax advisors, we need legal advisors, we need financial modelers, we need all these other service providers to support that. But you see, the way I see it is this: the minute you have a client who comes and says, I want to hear more on what the opportunities are in the capital markets, you already have a winning ticket. Okay. So my view is, let's start with repurposing the Iuka program, agreeing that yes, we do need to actually do the heavy lifting. Of course, one of the conversations has always been, these guys are not willing to pay fees to be advised. And then me having come from that side, I understand that.
Yes.
There is also the other bit of they will pay fees, they will take your advice, but they don't implement the advice.
Yes.
Then you're looking at each other. For me, I think Iuka Program stands a very good chance. It just needs to be repurposed. We need our ecosystem to walk the journey with us. We need the potential candidates for the Iuka Program to also be willing to close the gap on their end. This is advice that needs to be paid for. This is advice that needs to be implemented, and it's a journey that needs to be walked with all the challenges that come with it. I am of the view that as long as we have constrained capital markets, in the sense that businesses are not able to access capital from mainstream banks and all that, this platform will be one of the most critical platforms to enable us to achieve economic development.
Yeah.
Because if a lot of money is flowing into gambling and into CFDs,
Yes.
I have my own view on that. It tells you liquidity is not the issue, and of course into plots and pieces of land in the middle of nowhere. So it tells you there's liquidity, there's an investor education problem, there's a market dysfunction of sorts, and there is some high rent seeking capital providers in a certain corner of the room, and therefore it means we are constrained, including government. Risk aside, our government should not be borrowing at this sort of terms.
That was actually my next point, because when you talk about market dysfunction, and to be fair, we mentioned the pension funds. If the perceived, and keyword here is perceived risk-free asset is giving you 17, 18%, tax-free for an IFB, think about it. What incentive do you have to come to the equity side?
Julius.
And have you engaged Treasury on that, by the way?
Okay, before I talk about the Treasury, Julius, you are in the investment banking space. You probably are aware of having this sort of conversation in Ghana. And the people in Ghana today will tell you, what do you mean risk-free?
Perceived.
Okay?
I clarified.
So my view, a prudent investor, fund manager, treasurer should be allocating capital in a diversified manner. I think that is rule 101.
Yes.
Okay. Foreign investors are making a killing, investing correctly in the equity side, in the equities market. Okay. Why? Because they do their research, they time the market correct, they come into the market and exit the market accordingly. And they're making money. Okay. So it's not for lack of opportunity. Now, I agree that as long as we have the sovereign borrowing at those sort of terms, that it will be very difficult for a pension fund, for example, manager, to convince the trustees that they shouldn't put money in treasuries, they should buy, other asset classes. That's tough.
Yeah.
It's not unique to Kenya. I think it happens in other jurisdictions. If what is perceived to be risk-free is giving better returns, you park your liquidity there. The tide will turn either way, because the government, in my view, will have to deliberately seek a way to borrow at lower and lower cost. And we can see that almost coming to be the case.
Yeah.
I also think that it's also not in our interest as a country to milk the government dry. I don't think it is also in our interest either way, because what is it? It means banks are not lending to the private sector.
Correct.
Companies can't borrow. We are all giving the money to the sovereign.
Yes.
It looks like we are making money, but in reality, tunazungukana, so it needs to be solved.
Yes.
I personally, I'm really very optimistic about what our government is doing to address this issue and to stabilize the interest rates. And those that follow this closely know it's time to pivot to these other opportunities before everyone else does. And, you then, enter in the market at different terms. The second thing to mention is people sometimes don't appreciate that on the equity side, if you study these companies of ours that are listed there, a lot of them are not just doing business in Kenya. These are actually regional businesses.
Yeah.
So the lens also needs to be, I'm actually not investing in just Kenyan exposure. I'm investing in a regional play.
Yeah.
Exactly. So there's also that bit. Of course, that also means that ideally in a proper functioning market, we should also see a lot of corporate bond issuers, because it means these corporates are squeezed borrowing from the private markets. They need to come to the public markets and give a better proposition.
How will they give a premium over 18%?
Well, what option do they have? You want to borrow at 25? Look at it. What is the option? Either I don't borrow, or I borrow at eye-watering terms, or I sit down and craft a good proposition. I come to this market, say, fine, I'm going to borrow same terms as the bank, as an example, but longer dated. I'm not servicing principal, right? I can roll over depending on how well I do it. I'm only paying interest every 6 months. It's a no-brainer. I don't understand why any FD or CFO cannot see.
No, but Frank, let's be honest. And there's a reason why increasingly you are seeing the listed entities and even the non-listed entities seeking rights issues.
Yes, correct.
They're not floating corporate bonds. One, the premium is punitive.
Yes.
Two, you are not certain that even if you went to market, you will get the sort of ticket you want.
I beg to differ. First, I agree with you about the rights issue. It's a more or less cheaper way to raise funds. That I agree. However, you see, what I think is lacking in our market is proper curated borrowers. Okay, borrowers who take their time to actually put together their value proposition, their prospectus, their offering, okay, and come to the market properly. You know, where you walk the journey with the potential issuers, you do the book building, you actually unpack what you actually looking to offer. Julians, we don't have a proper functioning project finance market. We don't have a proper functioning syndication market.
Yeah.
Yet people are looking, quality borrowers are looking for funding and not getting it.
Yeah.
So it tells me what needs to happen is issuers need to actually take time to go through this process of curating their proposition, so that when they come to the market, it's a no-brainer that you look and you say, yes, I'll give T-bill plus 2.
Yes.
It's worth it. Okay. Number 2, even if you just said, I'm trying to refinance my existing facilities, I have been performing very well. I have been paying. I don't have an issue with payment. All I'm saying is, instead of paying 25, I just want to do it at 20. Come on now. It's a no-brainer, man. It just needs heavy lifting on the borrower side.
Yes.
And you see that is what is missing. Because having come from the private market, me can tell you, we sat and said, what appears to be easier? Going to talk to a bank, putting in the paperwork, giving collateral, get the money, or do a prospectus. You see that?
Yes.
Yes, that. Yeah. But as long as the sovereign continues to borrow at those terms, any astute FD, CFO, treasurer will have to reckon with, you know what? I have to do the heavy lifting to bring a value proposition that makes sense for pension funds, for investors, for you and I, through the public markets. I'm absolutely sure of that.
Frank, still on the macros, we have had a sovereign rate downgrades from Moody's, S&P, and Fitch. How have they impacted the market?
Obviously, those are not good news for our market, for the country at large. And you remember when I was saying earlier that it is healthy markets require a good balance between foreign investors and domestic. Because there is a risk perception issue, or rather, there's a difference between how foreign investors perceive risk and how domestic investors perceive risk. So that where you usually would find a credit rating movement by S&P may not necessarily be a big factor for local investors versus foreign. So to the extent that our market has a lot of foreign investors vis-a-vis domestic, then this sort of news typically would have an adverse impact. What we've not seen is large outflows in our market. Since April, we've had net foreign buyers, so that has not been a challenge. But you don't know which other investors could potentially have come but have therefore not come because of the credit rating. Given that you are from the investment banking world, you know a lot of these buy and sell decisions are these days driven by algos, and an algo has an input. If the credit rating is this, exit, or don't enter the market. So there are race implications. I do think that the government is working hard, at least from some of the insights I've seen. The government is working hard to manage some of these things. You know very well, if you read some of the documentation on these ratings, a lot of it speaks to fiscal side of
fiscal space, yes.
So to the extent that the government manages that, I think then we will probably correct. It's in our interest anyway to have better credit ratings as a country. And it's also in our interest to have more domestic
participation.
Exactly, because then we can have maybe better control of our destiny.
For sure. Yes. You've reminded me, was it early this year or late last year, I did a story and the tag in town became, forget fundamentals, BlackRock is buying, so just buy.
There is a lot of truth in that.
So Frank, this market judges the NSE CEO to a large extent by listings.
True.
And we've had a lot of promises. We've had a lot of conversation around listings are coming ever since the Kenya Kwanza administration took over rather. One, what's the latest update? And two, is there a pipeline, if any?
Okay, understood. Let me start by saying that in the old days, judging an exchange like ours on the back of the number of listings made sense. But most exchanges around the world, their business model has changed. Diversifying away from over-reliance on trading income, getting into other offerings, whether that's things like your data business, whether that's offering other product innovation type offerings, whether that's like the unquoted securities platform type offering, whether it's getting into training and things like this. So actually, any astute investor who continues to think that the NSE should be judged on the back of the number of listings probably has not taken time to understand the business model of the exchange, but also where leading exchanges around the world are going. That is not to say we shouldn't have listings. It's a metric in my book. So speaking to pipeline, there are 4 categories of areas of potential listings that we are looking at. The first one is, you alluded to it, the government side, so through privatizations. That has 3 elements. The first one is sell downs. You are aware the cabinet back in June approved sell downs of 6 of the listed entities. It's not a big ticket, but we're in the process of shepherding that so that hopefully the sell downs hopefully happen this year, because the process is fairly straightforward. The second category within the private, within the government side is, of course, sell down, the larger sell downs.
Yes.
Hopefully, the likes of KCB, Safaricom, Kengen, KPLC, where the government can reduce part of its existing stake. But these are already listed
divesting
companies.
further.
So divesting. The third category is the one that is more about buffaloes and less about the gazelles. So this is where we are looking for big privatizations.
Kenya Pipeline is a good case.
Kenya Pipeline is a good example. Now, I think the key point to make is that while the government, the current administration, put out a documentation of its intention to get the privatization bus off the road, going, there's a case in court, surprisingly filed by the other side of the government. That means that privatization process really can't happen until some of these issues are resolved. But I think the government's policy, as published, is that they intend to do privatizations. Some of those through the NSE, others through strategic exits, or in fact through JVs or any other legal legally allowed mechanism. So there is intention to look at privatizations from government. The second area we're looking at for potential listings is what we discussed earlier, exits by PEs. I think we discussed that in detail, so I don't need to get into a lot more detail on that. The third category we are looking at is family-owned businesses, especially family-owned businesses that are going through next-gen transitions that are ideally well-governed, dividend yielding, and all these sort of other features. And the last area of potential listings is cross listings. So we're in discussions with our PI exchanges across Africa, looking at potential cross listings. And then the last one is we also want to focus quite a lot on listing of structured products. So ETFs, REITs, of course,
yes.
indices, and these other sort of structured products that also give opportunity without necessarily having to chase a single issuer. So it's a bouquet of potential listings. Each of those has potential pipeline. What we are now doing is actually first looking at our new listing requirements under the POLD to really fine tune that so that it is as attractive as possible, as easy as possible, and more importantly, fairly straightforward. We can talk in a later date when you come for the bell ring.
Yes. Okay. Okay. Frank, on the family-owned businesses, I hold a different view.
Okay.
And this is a view I have shared with the Capital Markets Authority. I've shared with the exchange as well. If you go to other jurisdictions, there are prescribed minimum disclosures for family-owned businesses that will be deemed of public interest.
True.
And we have many in this country, just names withheld.
Yeah.
And the point behind the threshold of minimum disclosures is that finally it only makes sense to list and go public.
Yes.
And I've always proposed, why can't we have a similar prescription in this country? That's the only way you will catalyze a strong pipeline of family-owned businesses coming to market.
I think you have a good point there, but I think there's a line to walk that does not include coercion. I think, look, the way we were looking at family-owned businesses is, first of all, to solve a real issue around the next-gen transition, because that's a real issue. Okay, either they use our market or they will look for a strategic buyer or a PE because they truly need to transition. And in that scenario, the next gen is either not ready or not willing to necessarily, and it's surprisingly there is quite a bit of those. The value proposition we are proposing is one that seeks to solve for that. We, however, of course, also want to put a lens around businesses, family-owned businesses that are already used to disclosures, corporate governance, and this sort of reporting. Case in point would be, for example, family-owned businesses that have a stake that are in the banking sector, insurance sector, because by their nature, the reporting, disclosures, corporate governance is part and parcel of their business. Now, I like the idea of family businesses that are of public interest. We do need to maybe think it through and customize it for our market, because it might be a family business that is, by its nature, is of public interest, but it's really not investor ready. I don't know how to, So yes, it is, but we end up with a problematic listing, So, and I also believe that there are family businesses that, by their nature, they are very successful because they are family-owned businesses. Yes. So how do you ensure continued success? Because no one is willing to. I think we're not trying to just list for the sake of listing.
Correct.
We want continued success. So I welcome the point. Maybe after this we can talk a bit more on how to actually implement. Remember, execution.
Execution is everything.
Yes, but I take your point. I hadn't seen it that way.
All right. Let's dial down our conversation. NSC has just released its half-year numbers.
Yes.
And my own assessment, Frank.
Yes.
NSC has a cost management problem.
Sure.
One, is that a view you agree with? And two, what are you doing about this?
Okay. I agree with you that our cost to income ratios are not the best in the market. In fact, if you look at those numbers for for a number of years back, they have been going even worse. Okay, there are two big components of costs. One relates to our technology stack, and the other one relates to staff costs. So we have the same view that we need to really look at our costs and see how to manage those down. And that is a view that the board also holds, and the board has insisted that we need to manage our costs. So that I agree with that. As to what levers we have to manage those costs down, that's where I think the magic will happen. The first bit is to say that we are in the process of crafting our new strategy that will guide NSE 2025-2029. That new strategy will be interrogated, reviewed, and approved by the board this October. So we are currently in the process of formulating it. It does actually look at our costs, our cost stack up, and how to re-engineer that. But it's also true that you cannot cut your costs to profitability. That's not how, or to growth. That's not how.
Efficiency to a fault.
Correct, exactly. So we also need to grow our top line.
Yeah.
We've already started reorganizing our teams to be able to have more people out in the market and doing business development and these other sort of interventions. And the idea is we want to focus double down on growing our top line. There is immense opportunities in our market. I am actually very, very optimistic about that. We do, though, need to get our strategy right. We need to stay on top of our costs, and we need to execute 100% perfectly. Okay, because the sort of opportunities we see in the market, some of them will start bearing fruits, 1-2 years down the road, which means we need to get the execution right from the start, so that then we stand a better chance of breaking out. The second thing to mention, of course, is that we know we need to diversify quite well away from over reliance on trading income.
Trading income, yeah.
Yeah, because in many ways trading income is not really in our control. So we need to get into a space where we have, more control in terms of the direction of travel as far as growing those revenue lines are concerned. So we are going to put more effort on more focus on our data business, our advisory business. So we want to come up with specific NSE focused advisory offerings that do not have anything to do with what the brokers and the investment banks do, but that speak to the capital markets space. We want to grow our training business. We want to grow our product innovation business. And we also want to look at what tech offerings we could potentially go out, bring to market.
Yeah.
The opportunity endurance remains.
Yeah.
I think the key thing, especially with the guidance from our board, is that they want to see a bold and ambitious strategy, but more importantly, they want to see a clear roadmap for implementation.
Okay.
And then they hold me to task as a CEO to come through. I have no problem with a bold and ambitious strategy.
Yes.
I have a problem with not executing.
Okay.
So this conversation around our earnings will be very different in years to come.
Okay. Your cost centers are, to a large extent, quite tech-centric.
Yes.
Are there any measures you are taking in that side?
Yes. So three things I can mention. The first one, of course, is halting any material upgrades that are unnecessary or that can be delayed, and especially as we figure out what our new tech roadmap will be. The second thing, of course, is relooking at our existing costs, where we might either be overpaying or we are paying for things we are not using. So rationalizing that. And the third bit of it is looking at opportunities where we can get into, for example, revenue share model, where we don't get into a CapEx discussion. It's an OpEx discussion that's tied to outcomes.
Yeah.
Okay. So yes, there is we have quite a bit of opportunity to actually manage our tech cost. That said, some of the contracts we are in will require a bit of time to exit. Secondly, by and large, an exchange is a technology business. So we also want to make sure that transition is, any transition is well managed, because we can't afford to have the exchange, outage or these sort of things. The most exchanges around the world are, for example, on the cloud. We are looking into that. You might not be aware, but we are not on the cloud. Most exchanges also are running very successful data analytics and embracing this new emerging tech like AI and things like this. So we want to also look at what innovation lab or innovation offering can we have around tech. We have entities like the London Securities Exchange, Stock Exchange Group, that has invested immensely in its own tech capacity to develop solutions for the market. And MIT is a good example that's owned by LSE that actually services the market at very, very, very attractive, eye-popping premiums. We are their customers. So, So what I'm trying to say is, remember you had asked me about, judge me based on listings. No, that's as you agree, it's the traditional way. Now it's about how are you pivoting, how are you diversifying from trading, what sort of technology business are you actually building? Because that's really what it is. That is just a technology business that's offering capital market solutions, financial solutions. That's what we intend to also do for the NSE.
Frank, this market talks a lot about transaction fees as an inhibiting factor to activity in the market. Are you doing anything about that? First of all, do you see it as a challenge?
The answer is yes, but the question becomes for who? Because if you segment our market to the retail end, institutional guys, foreign, domestic, you start actually seeing the cost, the transaction fee conversation bobbing up for retail,
but not for institutional.
Not for institutional. So one needs to actually decompose that to really figure out who's who. And the cost value chain has different players. There's ourselves, there is CME, there's the broker. So that cost stack needs to be unbundled, and then we figure out where are the interventions that are required and for what, and for who rather, and also how to actually bring those costs to a level that is commensurate to the opportunity. So I agree that we need to look at the fees and the cost of trading and all that, but we need to have differentiated approaches depending on who we are trying to solve this issue for. If our market, for example, if day trading was working properly, the cost conversation might not actually be that relevant. You easily you can close out your position the same day, and you probably pay only half of your initial leg, or the movement that you're looking to harness to make a buck is there. I think what I'm trying to say is the complaints about costs is a symptom. It's not the root cause. The root cause is the friction in trading, the ability to come to the market and exit the market fairly fluidly, the opportunities that are listed, that are available for you to get into, and of course, the returns that you're making.
But Frank, if your mission, as you did indicate, is to deconcentrate the market from foreign investors to bring in local, and also retail, shouldn't that be a priority?
Yes and no. Yes, to retail investors, and for that purpose, whether they are here or diaspora or wherever it is. No, for some of the others, because I think this is not a pain point for them. They haven't traced it, they don't trace it, even in our service, they don't trace it as the main issue. The main complaint usually is We want more listings. We want more market data. We want more
More
engagement
products.
with more products. So actually, we need to solve what the market wants. That said, if we see that rationalizing the costs down enables us to have deeper, more liquid markets, that's the way to go. But as I said, NSE is a small slither of the cost stack.
Yeah.
Okay, so everyone else would have to also, sing from the same hymn book.
Frank, it seems like you're suggesting that NSE is ready and willing. It's other players who seem to be dithering.
What I'm saying is that this needs to be a collaborative effort. This needs to be a collaborative effort. You know what is interesting? When institutional investors go to brokers, they are able to negotiate fees.
Yeah.
Very, very competitive fees, I can tell you. That's not the case for these other entities. Actually, it also therefore means what retail investors need to do is come through as their chamas or their circles or funds. Then you can negotiate fees. In fact, it will be the brokers coming to you and saying,
please,
we give you, you know. So investors also don't seem to understand that they have a lot of power.
Yes.
But you see, if you go as
but they're not aggregated. You see, that's the problem.
This is an issue.
Yes.
This is an issue. Even us as NSE, really we can only respond to a certain critical mass.
Yes.
Okay? The regulator, on the other end, can only respond to a critical mass of agitation that is real. Not me and you walking into the office saying we demand lower fees. I'll be looking at you thinking, what, for 1,000 shillings? No.
Frank, we have to close this. And this is my final question.
Yes.
Our neighbors in Ethiopia are getting ready to launch their stock exchange. And we have seen exchanges like the Nigerian Securities Exchange buying a stake in it.
Yes.
Did NSE ever get courted? You didn't see an opportunity, or what was your response?
Okay, so there was conversation with the ESX, with the Ethiopian Securities Exchange. Our board looked at the opportunity and made a decision to pass. And to the extent that there was, reasoning for that, I think that's okay. This was before I joined. Yeah. Since then, we've actually spoken with the ESX and actually did sign an MOU to support the ESX build their capital markets ecosystem ahead of their planned launch. You probably are aware that they don't have any licensed investment bank, fund managers, custodians.
They've just come up with regulations. So,
yeah. So that means the market still has a long way to go to actually get put together. We think Ethiopia presents huge opportunities for Ethiopians and for Africa as a whole, including Kenya, of course. So we are staying very close to Ethiopia. In fact, I'm going to Ethiopia on this coming Tuesday. We have some advisory mandates there. We are supporting a number of banks to help them understand the capital markets and how to actually approach them. We are seeing a lot of our local businesses here, including listed companies, starting to look at Ethiopia. Obviously, at the time we were making this decision, some of the changes that have happened since then,
the liberalization
had not taken place, and there was no indication at that time that was going to happen. There's reason to relook at Ethiopia. I think for any person in the neighborhood, I think it's a very promising market. But I also know from having supported clients in Ethiopia that it's a unique market.
It's a long game.
Yes, it's a long game for sure, and it is good to understand. Take time to understand it. But I do actually see huge opportunities there. The big opportunity I see going forward is the potential for cross-listing. I also see opportunity to have a larger pool of capital that is available within the larger East Africa market that can potentially come to the market, especially given that potentially now the flows of capital might be less restricted. That means there are Ethiopians who could invest in our market. So maybe we should be talking about doing a roadshow to activate the Ethiopians to invest in our market. But we are here to collaborate.
Yeah.
You are aware of the Africa Securities Exchange Association.
Yes.
So obviously, once ESX is in play, it will be a member of that association. We also have the East Africa Securities Exchange Association. So we think that in time also we will have Ethiopia join.
Okay.
Somalia also has an exchange, in case you're not aware. So I think, look, the larger the pool, the better. The more linkage we can have, the more cross-receipts we can have. It's good for everybody.
All right.
Yes.
Frank Mwiti, unfortunately, we have to close it at that point. There's a lot more, but I guess this is the first of many.
Indeed. This was, I enjoyed actually.